There is so much demand to access Bitcoin from institutional investors and companies. It's outweighing the supply of new Bitcoin by a factor of 5 or 6 to 1. Bitcoin's already had a good year, but I think particularly as we get into the fall and institution allocations heat up, as major wirehouses like Wells Fargo and Morgan Stanley start accessing Bitcoin, I think we have the potential to rip to 200,000 or beyond. I know it's a long way from here, but I think we're getting there this year.
Historically, Bitcoin has followed a well-known 4-year cycle, marked by massive rallies and brutal drawdowns. 2014, 2018, and 2022 all saw Bitcoin fall 60–70%. Many expect that pattern to repeat in 2026, but Hougan pushes back. He says this time is different, not in a naive way, but structurally. Why? Because the underlying drivers of those cycles, such as halving events and Fed interest rate changes, are less influential today.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
You know, I see all sorts of people looking at the current financial market and saying it's good enough. Saying that it's good enough that our bank accounts pay us no interest. It's good enough that stocks only trade 9:30 to 4 p.m. It's good enough that we pay a 2% fee every time we use our Visa card. And I want to cry for those people. The financial system can be better. It can be 24/7, 365. It can be global. It can be frictionless. We can have better money. The reason why crypto is the only technology we have that offers us the opportunities to significantly upgrade the financial ecosystem. And I was trying to point out in that memo that that's possible and that there's a better world on the other side if we can get there. I think it's going to go up in 2026. He's absolutely right that for the last 4 years, in 2022, 2018, and 2014, there were big pullbacks in the crypto market, and Bitcoin did fall 60 or 70% in those years. But that's not a guarantee it will happen in the future. When I look at the market, I see the factors that drove that historical 4-year cycle, like the halving and interest rate cycles, being weaker right now. And at the same time, we have institutional capital moving into the market that's going to take 5 to 10 years. And I just think that institutional capital will overwhelm that historical cycle. Does that mean we've repealed volatility? Absolutely not. Could Bitcoin fall 30 or 40% even? That's certainly possible. I don't think we're going to fall 70%, and I think we'll post positive returns in 2026. So I guess I'll take the other side of that bet. There is so much demand to access Bitcoin from institutional investors and companies. It's outweighing the supply of new Bitcoin by a factor of 5 or 6 to 1. Bitcoin's already had a good year, but I think particularly as we get into the fall and institution allocations heat up, as major wirehouses like Wells Fargo and Morgan Stanley start accessing Bitcoin, I think we have the potential to rip to 200,000 or beyond. I know it's a long way from here, but I think we're getting there this year. I think what you're going to see in the altcoin market is a real differentiation between coins that are gaining fundamental traction in terms of use and applications and coins that aren't gaining any traction. So historically, altcoins have kind of moved all in sync, either all up or all down. Bitcoin and Solana and XRP and Cardano all moving together. As we enter this more fundamental era of crypto, where it's really disrupting traditional finance, I think you'll have winners and losers, but the winners are going to win big. If I look at Ethereum right now, I think it has tremendous tailwinds behind it that aren't priced into the market. So I'd put that into the probable winner camp. But not every altcoin will rally. Some will and some won't. Stripe spent over $1 billion, one of the largest payments companies in the world, spent over $1 billion to buy a stablecoin infrastructure provider that lets companies and other industries invoice and receive payment from places around the world. Things like Starlink, Elon Musk's satellite internet company, uses Bridge to invoice people around the world. And Stripe thought this is going to be a big business. What that means for you is this is a major institution saying stablecoins are a big part of our financial future. How do you benefit from it? You have two ways. One, you could buy Ethereum which is the primary blockchain on which stablecoins move, or you can buy companies that are building these stablecoins like Circle, or an ETF like our BITQ ETF that owns these kinds of companies. Either way, BITQ or Circle or ETH, you're getting exposure to the stablecoin growth, which I think is going to be a multi-year story measured in many trillions of dollars and is an enormous opportunity. A stablecoin is a digital dollar that moves over blockchains, kind of like a money market fund, but it doesn't pay interest and it moves over blockchains. Its primary use is in crypto trading or in international commerce, or from people in emerging market countries that want access to the dollar. You can't invest, or you won't earn any by just buying a stablecoin, because by definition, it stays stable, right? It'll sit at $1. So you need to invest in the companies that are building these stablecoins, companies like Circle and Coinbase, or on the rails that these stablecoins move. As an example, every time someone sends a stablecoin, if I were to send you money in a stablecoin, Adam, I would send it over the Ethereum blockchain. I'd pay a small fee in Ethereum. If you think 100 times more people are going to be doing that in the future, maybe you want to own some Ethereum to benefit from all that fee activity. So buy the companies or buy the blockchain, or maybe just buy both. I think it depends on how you want to measure risk. I think there's risk for companies building in this space. It's a new market. It's an emerging market. It's not clear who the winners will be. Will it be crypto native companies like Circle, or will it be JP Morgan when they come into the market with the stablecoin? That's a risk as an investor. In terms of the risks for the banking and financial payment system, I think it's mostly all upside. I think this is just a more efficient way to move money. It's a little bit like saying, what are the risks of email? Well, the risk was it would disrupt the postal service, but email itself was just a better way to transmit information. Stablecoins are just a better way to move money over the internet. And I think it's mostly upside for the world.
In Hougan's view, this solves most of the historic risks in stablecoins, like the collapse of Terra Luna, by ensuring that only secure dollar-backed tokens exist. There's still risk, as with any innovation, but he compares it to the early days of email or online trading. Yes, we saw flash crashes and fraud, but the overall improvement was undeniable. And unlike banks, which can collapse from mismatched loans, hello, Silicon Valley Bank, a treasury-backed stablecoin is much safer.
Well, any technological change comes with risk, right? When we moved from trading stocks on the floor of the New York Stock Exchange to the electronic markets, that made the market much more efficient, lower cost. It improved liquidity for every investor, but it did come with some risk. We had risks. We had things like the flash crash, right? That wouldn't have happened in a floor-based system. So there are always risks when you try to improve things. But the question you should ask is whether the benefits outweigh those risks, right? It certainly did when we moved from floor trading to online stock trading, from full cost brokerage to low cost brokerage. And I would argue it will in crypto as well. Now, saying that, I'm not being Pollyanna. I can look back at crypto, and there have been plenty of reasons to be concerned about this industry, right? We've had FTX, we've had custodians blow up. There's been a lot of fraudulent activity. I think it's hard for people to recognize that we can solve those risks through better regulation and then harvest the benefits on the other side of this incredible technology. This is exactly why the Genius Act is so important, because what you're describing is what crypto entrepreneurs were trying to do with stablecoins in the past. The way the Genius Act worked is the only thing that can be a stablecoin is something that's backed 1-for-1 with short-term US Treasuries. So instead of holding Adam's altcoin, it holds, 30 to 90 day duration short-term US Treasuries, which are the most secure asset in the world, and it's backed on a 1-for-1 basis. So exactly the risk you're calling out is why historically stablecoins were risky. There was the Luna stablecoin, which blew up. There were a number of other issues. Once we get into this new regulated format under the Genius Act, that goes away. The only thing that's a stablecoin is something where I deposit $1, I give you short-term treasuries, and you issue me a digital representation, and you can always go back and forth. So that should fix that problem. That's why this bill is so important. Yeah, I mean, that is one risk that people have called out. If stablecoins come to be a huge share of the US Treasury market, and people want to cash out of that, could that interest is sort of create interest rate volatility? But you're trading risks there, right? There is that risk in the US banking system right now, except it's much worse. When you have a deposit at a bank, they may make a long-term loan, and then if people ask for their money back, the government has to bail them out. We saw that with Silicon Valley Bank. So you could see, I guess, a little bit of volatility in the short-term treasury market, but it's the most liquid market in the world. And you're trading that versus the volatility you saw in the traditional banking system, where banks fail pretty regularly and we're forced to bail them out. That's a trade I would make. That's an upgrade in my view. It happens. Silicon Valley Bank happened, right? Signature Bank happened. Small banks fail relatively regularly. Doesn't happen every day, but compared to what happens in a well-regulated stablecoin where the backing is the US Treasury, that seems like a pretty good deal, right? I mean, a 30 to 90-day Treasury deposit is definitionally safer than an unsecured banking deposit above $250,000, right? Where you don't have certainty you'll get your money back. In the Treasury market, I think you have a fair degree of certainty that a 30 to 90-day Treasury can be liquidated at or around par in almost any market environment. Yeah, I think, as long as you're within this regulatory framework, the word run may be inappropriate. If you lost faith that they were adhering to the regulations, or if there was some element of fraud, people could ask their money back. Regulations don't repeal fraud, but barring that, I don't see why this would be a threat. In fact, I'd note that they built into the Genius Act a rule, which is stablecoins can't pay interest, out of concern that people would migrate to them as being safer than banks, right? They wanted to maintain banks in a differentiated framework, so they sort of hamstrung stablecoins a little bit in the bill, because I think the underlying structure is sort of fundamentally, definitionally more secure than the traditional structure in a reserve bank environment.
All innovation comes with risk. But Hougan's message is that missing out on progress is the greater risk. Crypto, and stablecoins in particular, represent a massive leap forward in efficiency, transparency, and access. Will there be volatility? Sure. Winners and losers? Definitely. But if you're still stuck debating whether crypto is real or whether stablecoins are risky, you may be looking at the wrong problem.